Good morning and happy Friday, and welcome to another episode of the Market Pulse with our executive from the trading desk, Tom Gale. Mr. Gale, how are you?
I'm good, thanks, Palesa. It's a nice change of chairs. We get a break from Addy.
Yeah, it's a nice change of chairs. So I get to be in the hot seat now. But lots to talk about as it happens in our environment. And I would like to actually start off with the U.S. um, uh, uh, Supreme Court and those Iranian and U.S. tensions. Tom, what is happening there?
Indeed, as usual, lots to get our heads around. There's certainly been some risk premium sitting in markets globally, um, and right now, for this particular pulse, I'm picking out these two topics. It's actually interesting psychology. It's the enemy within and the enemy without, as certainly as the White House administration would see things. The first thing, as you and your audience would well know by now, the US Supreme Court struck down White House use of emergency powers, IEEPA powers to implement tariffs. And and that led to Donald Trump lashing out and accusing several sitting judges on the bench of poor behaviour. Essentially, it's very undignified, of course, and
No, of
certainly
course.
unusual that
Mm,
a president would uh, extend criticism to the Supreme Court, not least because the US Constitution recognizes a separation of powers, of course, between the executive and the courts. So it once again does muddy the waters somewhat, and it certainly plays to the narrative, as I say, of an enemy within. The enemy without right now is Iran, and we're all bracing ourselves. Markets have been bracing themselves for a US strike on Iran, probably some sort of targeted strike. They've done this before, of course, last year on Iran's Tehran's nuclear military nuclear facilities, and this might be a targeted strike again. But we can see. We'll come to this in a moment where we see the risk premium. I just want
perfect.
to I want to
I
take
just
a
want,
step back. Yes,
sorry,
Balesa, you go.
I just wanted to ask you a question, actually, just going back to the decision by the US Supreme Court around tariffs. I just wanted to, as a retail investor, does this mean all the countries that were affected by tariffs, does it mean they're all off the hook? What does that decision actually mean when I'm sitting down as an investor and making my decisions?
Indeed. Well, a good question to get us going. The answer is that, as we broadly expected, should the Supreme Court strike down use of emergency powers, that the White House would just find another legislative route to implement tariffs. And so on this occasion, the White House has used a 1974 act that allows the president to implement blanket tariffs, flat tariffs,
Mm-hmm.
for 150 days, beyond which uh, to uphold them, they would need congressional approval. Without getting too much
Into
into the
detail.
details
Mm,
here, I think the takeaway here is, to answer your question, is, well, there'll be some winners, some losers from this, because those countries that were paying higher tariffs under IEEPA measures might now pay a lower tariff based on a flat tariff of 10 escalating to 15%, and then there'll be
mm-hmm.
other net losers, those who had struck deals with the US, who might now be paying more. So, but the uncertainty of what happens after the 150 days, and the uncertainty of whether there are any refunds available to US importers that ultimately paid the tariffs,
Mm.
the tax, it just really does serve to undermine the dollar. And this brings us in nicely to the slide that I'm sharing here.
Yep.
You and your audience will be familiar with the narrative last year. Excuse me. Yes, last year of the
Yes.
of the dollar weakness. And the chart that I'm showing here shows that the dollar sold off from about the time of Donald Trump taking office to current levels of about 10%. Our G10 currency strategist, Steve Barrow, does expect further weakness for the dollar this year,
Mm.
a move of similar magnitude, but he's at pains to explain that it will come in episodes, and
Okay.
actually, just to sort of complicate the story a little bit, he doesn't see the Supreme Court ruling per se as a catalyst for the dollar weakness right now, and besides, Steve reminds us that if there is a military strike on Iran, that typically sees a bit of dollar strength. So actually, over the last week, the dollar's been holding up okay. I want to leave you and your audience with one abiding thought, though, for the months ahead, and that is that the dollar is going to weaken because of this undermining the constitutional tensions and so on, um, and just broad debasement. So over time, we must be we must be accustomed to the dollar continuing to be weak, further bouts of
Mm.
weakness, and that will ultimately lead to the rand, therefore, being stronger,
Being
dollar rand
stronger.
lower.
Mm.
Yeah, that's it.
Mm.
So I want you to hold that thought. Okay.
Okay, we'll remember that at least when we can travel overseas for a better premium this time.
Well, you want to put your rands to work. I mean, you know, the obvious.
Exactly.
Well, the one way to do it is to travel overseas. The other way to do it is to take your rands and use your rand proceeds in dollars or pounds, using WebTrader, of course. Okay,
And
so
absolutely, and you can obviously leverage that, get those Nvidias and those Apples on WebTrader or Shift, depending on which one you prefer at the moment. Yeah, and leverage that weakness in the dollar.
that's it. There we go. There's one good way to do
Awesome.
it. That's it. Okay, but just to close off on this point around premium that sits in markets at the moment, we'd see it most notably in the oil price. The chart on the left. Broadly speaking, it's difficult to boil this down to a science, but somewhere above $60 a barrel of oil, that there is geopolitical risk premium. There's plenty of oil in the world right now. Supply is not a problem. Demand is a little bit lighter, broadly speaking, and it's very tempting to argue that the oil price should be low 60s, maybe even 50,
Mm.
high 50s, if it weren't for current tension around military action. Just bear that in mind. We also know that Donald Trump does not like oil above $70 a barrel, and remember that this is an election year for
For
the
him.
White House as we head towards
Mm.
midterms. So I think that there's premium in oil right now, but it won't it shouldn't by rights last for long. Um, on the right here, the graphic shows polymarket pricing of the likelihood of a strike on Iran, and you can see that there's a very high likelihood before the end of the year. What we are concerned about today, in particular, is the chance that there could be a military strike tonight, tomorrow, and I think that's it's not a zero probability. So we're just a little bit concerned about that for the
About that.
moment.
Hmm.
Um, but if oil is elevated, um, we've also got very used to precious metals and gold being elevated, also on geopolitical risk premium, diversification for central banks away from dollar, and so on. What we learned again, Palesa, in the last sort
Yes.
of couple of weeks is that any dip you get in precious metals, you really must buy it.
100%.
And
We have to
platinum
take advantage,
have to take
especially
advantage.
because we haven't seen those prices in a while with the rally in the precious metals that has been going on for some time now. I mean, some people could even argue that rally has been carrying our economy for the better part. But that's obviously open for debate. But speaking of that, really, Tom, I saw the Valterra results were pretty good. And any thoughts on that or comments?
Mm. Yeah, well, that's well spotted, Palesa. And indeed, it is certainly true that these platinum group metals mining companies are really performing very well given the high price of the metal. They are free cash flow positive, which is a big turnaround in the last 12 months
Mm,
for some of them. Valterra, very good set of results, and this is certainly a very well managed company. We have a buy recommendation on Valterra. We also have a buy on Northern Platinum, and we are urging investors to hold the platinum miners. And in particular, we think that there's good operational gearing in the miners over just holding the metal via the
mm.
ETF, for
Oh, okay.
example.
Mm-hmm.
You can hold both if you didn't want to take the operational mining risk. Of course, you can just buy uh, the ETF Platinum ETF, which you'll find under the code ETFPLT. Of course, I just want to also remind you and your listeners that the price performance for platinum, the price performance for the metal, is very closely tied to the Chinese market these days.
I was
Since
just about to say, after the Chinese actually came back from their festivities over the New Year, you see the run in the platinum price.
That's right. And actually, what I'm showing on the graphic here is the shaded area in red is when the Chinese market and specifically Guangzhou platinum futures were closed for the Lunar New Year, and then the green shaded area is when futures markets in China reopened. So it really is the case, and we've been commenting on this for the last few weeks, that there is a lot of speculative interest in platinum and to some extent palladium in the Chinese market, courtesy of the new contracts that trade there. So yes, it's a Chinese underpin for platinum, and we think for good reason. Speculative it may be, but it's for good reason. The fundamentals are very positive for the PGM market. So yes, Valterra, Northam in particular are good ways to play that from a mining point of view. Um, you did mention a very interesting point a moment ago, arguing quite rightly that some of the economic performance for South Africa has been courtesy of higher metals prices. That is certainly the case, and the Treasury talked to that at the budget this week, in particular tax receipts, for example. We know, of course, that the platinum and gold miners are very important for dollar receipts. Uh, those mining companies sell their metal in dollars and then repatriate to rand, and so that's one reason why the rand has been so strong and will remain strong for the time being. But yes, it's certainly fortuitous for the South African economy that precious metals prices and other metals prices are holding up very well.
And I mean, thanks for that, Tom, because I see when the minister delivered the budget, a lot of investor confidence was boosted once again. Tell us how that's also going to be tying into how you guys are seeing the rally in the JSE. Do we see any positives in that rally because of that good budget that we had?
Yeah, well, look, first of all, as you say, it was a good budget. It was investor positive. I don't want to overstate this point. We're coming from a low base, and we all know that. Those of us
Yes.
have lived in the country for the last few years. I think we can consider this a rebuild in credibility. We've come a long way since the really poor fiscal discipline of recent years. A few years ago, of course, we were downgraded to junk status
Mm-hmm.
by the credit agencies. Ours is a rebuild. I think we would absolutely accept that. We're not these are not heady days of boom by any stretch, but investors gave the budget a thumbs up, and the chart on the top right here shows government borrowing costs, which have been dropping to multi-year lows. And anyone who doubts the story of gradual reform here need look no further than bond yields. We're getting a thumbs up from investors. I will come on to the JSE read
Yes.
across in just a moment.
Sure. And just before you do that, Tom, do you still see that those debt costs as a potential risk that could put us in jeopardy in terms of just achieving our goals as a country?
Well, we must be mindful. I think you came up with a statistic just before we started the recording in terms of our debt servicing costs. Again, Palesa, we're under no illusions that we come from a tough place,
Mm,
and it's really the direction of travel that's important to markets. Um, One way to deal with high debt servicing costs is to grow the economy. So you create income. And that's a piece that has broadly to date been missing. There are some green shoots. In fact, our South African economist Elna Moorman talks of green shoots, and we saw that again this morning actually in Reserve Bank data showing extension of credit, especially corporate credit, growing
by banks.
with a bit of momentum now. So that's good. Another way to deal with high interest servicing costs is is to prove to investors that you're taking measures to head in the right way. So given National Treasury auctions South African debt on a weekly basis, they're able to auction that debt at lower debt costs, lower yields, as you can see demonstrated in the graphic. And they took an additional step, which was very positive for the market this week, when they also announced the amount of debt that they sell at weekly auctions is to be cut. So less dependence on debt is also gave invited a thumbs up from investors. So this is all taking us in the right direction. Key fiscal metrics you can see on the graphic on the bottom right there shows the country heading in the right direction, and we have peaked in terms of debt, our debt to GDP ratio, and that gives investors a whole deal of comfort too. But
And
how?
Tom, just before you continue, can I just ask, in terms of just looking at fixed income instruments as a retail investor, is that something that I can look at? Or how, now that we've touched on extensively on the lower yields?
We do have one ETF, so an exchange traded fund that is listed and gives you economic exposure to South African bonds, ETF BND, Bravo, November, Delta. But it's typically not an asset class that is readily tradable for online share trading investors, and Adi often repeats this point. I think, however, you're going to get the benefit. Everyone's going to get the benefit
Mm,
from better budget, lower government financing costs in better share performance across the board. If you are a South African registered company, you will be feeling the benefits over the long term from the positive macro, most notably, by the way, in the banks, in the banking sector, where we remain very positive. Our analyst Charles Russell is still very positive on the banks,
mm,
and the banks have done so well recently, in particular because of the rally in our bonds, the lower bond yields that you see on that chart on the top right. That really is the banks are as good a proxy for falling bond yields as anything. But as I say, good policy is better than bad policy. That's
yes.
certainly a truism, and good policy does help with what should be a re-rate for South African shares. We've been very positive, as you and your audience will know now, for a couple of years on South African shares. The JSE has performed very well, really
100%.
on a global basis, comparably, for the last couple of years, and will continue to. So we see returns broadening through the JSE. It's really a catch up in particular as in the financial sector, as I've mentioned banks, but more broadly in the financial sector, and in industrials as well. We've got plenty of value. Our analysts for the consumer stocks see plenty of value there, but there is some conviction, doubts on the prospect of a short-term turnaround for consumer stocks, because the fact is that cost of living continues to bite for a lot of people in this country, and add to that competition is intense from international brands, especially in the apparel sector, where some of the Chinese entrants have taken enormous market share from South African apparel retailers. Look, I think worth just recapping on some of our top picks. As I say, banks, our analyst is positive on Standard Bank, on Capitec, benefiting from a pickup in loan growth that we mentioned, an improved fixed investment cycle, and we are seeing green shoots there, should boost the construction sector. Raubex remains one of our top picks there. It's one that I've talked about in the past. General industrials, also very cheap. Bidvest screens very well for us. So there's plenty here for you and your audience to look at
Chew
on
on.
Online Share Trader. Absolutely.
Mm.
And I've listed at the bottom of the graphic, the bottom of the slide here, some of our top picks across the board. I think before we sign off, Palesa, we need to talk briefly about some of our structured products, and we've got a suite of structured product that we are offering to online share trading audience. They're typically designed for those who have a lower risk appetite, and perhaps might look for a level of capital protection with some returns, albeit locked in. And I think the sensible thing would be for us to take one of these products at a time, so we don't get lost. And so I'm actually going to pick on the Quantum Plus to talk you through what we can offer here. Now, the Quantum Plus, as with all of these products, is structured on the JSE Top 40. What the Quantum Plus does is takes your capital for a term of 5 years. However, after the first year, the capital that Standard Bank takes will be 50% repaid to the investor after the first year, plus a coupon of 16%.
Sounds like a sweet deal to me, Tom.
Pretty good if you are looking for a safe investment and a coupon at the end of the first year. Now, thereafter, for the following 4 years, your participation in the JSE Top 40 is capped at 50%. So you'll get just 50% of the performance of the top 40 over the following 4 years, albeit 100% capital guaranteed over that time period. So if the JSE is down over the next 4 years, or over the full term of the 5 years, I should say, you're protected. You're going to get your initial capital back. If the JSE is up, then you get to participate in that at a rate of 50%. So there we go. There's the first product. What I would urge you and your audience to do is to speak to our contact center, and there are some contact details on the slide here. It is highly important that you speak to one of the advisors before you make your final decision.
Fantastic, Tom. Yeah, and as always, thank you so much for your time, Mr. Gale. I hope you do have a wonderful weekend. Signing off, Palesa Moyaba, Retail Investments, and Tom Gale, Executive at Global Markets. Thank you all.